Hey, what's going on, my friends? We are back with another $25 a week dividend portfolio update. Today is Sunday, October 3rd, 2021. And as you guys can see, our current value of our portfolio is up to $1,500, $1,532.88. Of that, you can see over the past day, we're up 0.74%. But when we jump to the past week, you can see that things had taken a bit of a downturn a little bit, where we were down negative 0.81%. The past month, we're down 3.68%. And the past quarter, we're down 2.78%. However, the past year and all time, you can see our portfolio is up with a return of 6.83%. Now, part of the reason I've continued to stress the importance of considering having a dividend portfolio, or at least having dividend companies inside of your portfolio, is because of their ability to withstand these downturns. When the economy crashes, which a lot of people are saying we might potentially experience a crash, a bigger crash than what the market kind of faced over the past 2 weeks or so in October. And if we do, well, we will still have our dividends coming in, and we won't really care about, this return. Like, you want to have the return be as high as possible. So I don't want to say we don't care about that. That would be ridiculous. But my point is, when you have a dividend portfolio, you just want to have good companies that are going to always be giving you out dividends, regardless of where their stock price is. That is the benefit of having a dividend portfolio. And I came across this article that basically speaks to 75% of S&P 500 returns come from dividends between 1980 and 2019. So when people are like, well, you should only have dividend portfolios or dividend, stocks and stuff if you're older and if you're living off of the money, if you need that income, that the dividend payouts to live off of that while your other money continues to work. Well, this kind of helps to show why that's kind of rubbish and why you probably should consider having dividend companies inside of your portfolio. In the short term, and I'm just reading this, I'm only going to read these first two, maybe first three paragraphs, but it says, in the short term, stock returns are dominated by the ups and downs of price movements. In the long run, stock returns are dominated by dividends. A common question is, what percentage of stock returns come from dividends over the long run? To which I have a simple answer using the past 40 years of S&P 500 returns: 75%. Reinvested dividends over the long term is part of the first and more stable way to make money in stocks. Today's chart shows the growth of an initial $100 in the S&P 500 ignoring dividends versus with dividends reinvested. The S&P 500 index has risen to 17.9 times its 1980 value, but with dividends reinvested, $100,000 would have grown 52.9 times to $5,285,910. So next time you think that a 2% dividend yield is not much to get excited about, remember that unlike interest payments, dividends tend to grow over time, as the part of the company's earnings not paid out to you as a current dividend is often reinvested to make future dividends bigger. The latter factor, as well as taxes, is one reason I don't only buy high dividend yielding stocks, but something making up 3/4 of the S&P 500's fabulous return over the past 40 years is a big enough factor to never ignore. So when we look at this chart, you can see how much of a difference the S&P 500 is with no dividends compared to S&P 500 dividends being reinvested. The power of compound interest, my friends, incredibly powerful, and a major reason why you want to have a dividend portfolio, or at least have dividend stocks inside of your portfolio. Now, I wouldn't say you should have, don't just, like, this might not be the best approach for you. However, you might want to consider having more growth-based dividend stocks in here. One company that I keep saying and talking about, thinking about adding into the mix is Apple. And when we jump in here and we look and we see over the all time who's kind of performing best and who's performing worst, well, AT&T tends to be at the bottom. Oh, well, 3M actually just passed them now. AT&T had been at the bottom for the longest time with our portfolio. And I was saying, I didn't want to get rid of them despite a lot of other people jumping ship on AT&T because of their upcoming merger with Discovery and how they're going to be cutting their dividends. Well, I'm looking at it, and the reason why I hadn't done it and I've been reluctant to get them out of the mix is because I'm looking at it as a potential growth dividend. So meaning, yes, they're going to reduce their dividend payout, but it's only because they want to reinvest some of that money into their company so they can focus on their growth. So they want to stay relevant. They want to make sure, hey, they're going to take a bit of a hit right now so that they can reinvest in themselves and be relevant and dominate in years to come. So for that reason, I've decided we're going to keep AT&T here in the mix with our portfolio. We're going to continue to invest in everyone you guys see in the mix. Let's do our little update. Just, cover who's killing it as usual. We have Newt up at the top with a 32.25% return. Then we have JP Morgan Chase with 17.23%, PepsiCo at 15.58%, Realty Income at 10.11%, and then we have Procter & Gamble, Coca-Cola, Johnson & Johnson, Verizon Communications, AT&T, and at the bottom is 3M. So things are going well. When we looked at our earned dividends to see who is killing it, where is our money coming from? Well, most of it is coming from Newt. And after that is AT&T, followed by Realty Income Corp and Coca-Cola. So again, despite AT&T being at the bottom of our list, kind of continuously at the bottom of that list, they are among the higher paying dividend stocks that we have in here. And so it's a trade-off. If we were talking hundreds of thousands of dollars or, a lot more money than what we're working with, well, that money would be much higher, obviously, in terms of the payout from AT&T, which might make you say, okay, for how much they've dropped with their stock price, the amount that we're getting from them from the dividend is worth it. And despite knowing they have those plans to make a dividend cut, well, they're going to be cutting the dividend payout so they can reinvest in their business more. So again, it's a trade-off. It's not like we are dependent on these dividend payouts. We're not. We don't need that right now. This is a long-term portfolio. This is a long-term goal. So technically, we don't have to worry about that because we're not living off of those dividend payouts. Now, yes, we want to see as much as possible come back and be reinvested, but it's not make or break. We can still work with what they have going on for the time being, at least, and see how things develop with their merger with Discovery. So things are looking pretty good, as you guys can see. Like I said, we are up well over now. I don't say well, but now it looks like we're over that hump of $1,500, which is great. It's where we want to be. And, we're going to just continue to chip away at this portfolio, continuing to add $25 every week and building up our wealth. So if you guys haven't already started your portfolio, I have a link down below to M1 Finance where you can create your own dividend portfolio and add other companies that don't pay out dividends as well, of course. And, if you use my link down below, you can get $30 for free. Maybe it might be a little more, a little less. And then I also have a link down below to Webull, which is another one of my favorite investing brokerage platforms. And, if you use my link to Webull and fund your account, I believe you get some free stocks. So not a bad way to finish off the weekend and kick off the week. Another new week, first week of October. It's going to be a good month. I have a feeling it's going to be a good month. The market might be a little iffy. Some people think a crash is coming, but I think once we get this potential crash, this next crash, we'll be good for a while. So, part of me is like, I kind of want to see it to some extent. I just want to get it done with, right? And also look at it as a buying opportunity. As these companies crash and their stock prices fall, that is the time you want to consider buying. So although we're only adding $25 every week, hey, there might be a stretch of 2 weeks or a month or 3 weeks or whatever that we can add maybe twice as much, or maybe a little more, maybe not twice as much, but maybe you can squeeze out a little more money, and it's during those times when the market is red, that people are panicking and freaking out, that you want to invest more so you can grab more of that market right there while it's nice and low and affordable for you before it takes back off and the economy picks up again. So, hey, I'm not a financial advisor. This isn't legal or financial advice. Of course, I don't know if a crash is coming or not. I mean, Robert Kiyosaki was just saying he thinks the crash is coming, but he always thinks the crash is coming. So I don't know. We'll find it. Only time will tell. But the better prepared you can be for it, the better you will be to withstand what's to come and be able to, make more progress and work your way higher after the fact. So. Just getting prepared, helping to, plant the seeds there, because it might happen. And if it does, like I said, that's the time you want to, any extra money you got sitting on the side, that might be the time you want to make some moves. But all right, my friends, I got to keep it moving. Hopefully everyone is having a great weekend so far. We got the Patriots and the Bucks tonight. Going to be a big game. Everyone's like, Tom Brady is going to kill us. Hey, I don't know. I think Tom got a little extra pressure. And I think Bill, at this point, everyone already thinks Bill lost, and Tom, since he won it all last year, they're already kind of like, So, hey, I think Tom has more to lose than Bill Belichick at this point, and I think Bill is gonna come ready, got the team ready. The team knows, hey, we need a win. I think the Patriots are gonna take this one, or I'm just hoping, because we all know Tom Brady is the GOAT. But sometimes goats get eaten by wolves. So, hopefully the Patriots can come prepared today. So everyone have a great day. Also, really quickly, on the website, makemanagegrowmoney.com, finally have a course up. Technically, I'm still making some tweaks to it. And I'm trying to make a decision if I'm going to have a small fee for these courses or how I'm going to do this, if I want to have additional content. So if you do head over to the website, makemanagegrowmoney.com, click on all courses, and you will see the first course, which is on how to start a business. So definitely check that out. And I will have tons of other content up there very, very soon, other courses and whatnot to help you with making, managing, and growing money. But all right, my friends, you guys already know I got to keep it moving, but I'll see you in the next video. But first, don't forget to like this video if you haven't yet, and also subscribe to the channel. Hit that notification bell so you can stay up to date on our latest and upcoming videos. All right, my friends, now I got to keep it moving, but I'll see you in the next video. Peace.